It's been a good year so far for Hannover Re. First quarter net income was up, gross premiums beat expectations, a combined ratio of just 95.7%, and an ROE of almost 14%. All in all, a pretty good start to the year. The company also participated in two major ILS transactions. We spoke with Hannover Re's chairman and CEO, Ulrich Wallin, about these and other topics here at the S&P Insurance Conference. Here are the highlights.
Well, you're asking about our involvement in the recent ILS transaction for the wind pools. We run an ILS department since 2008, where we work together with the capital markets, and this is just one of the transactions that we're doing as a result of that. This is a little bit more well known because we do press releases and things. For us, we're helping in the structuring, we offer the fronting for it, and we earn a fee for it. But I have to say that we had a very good cooperation with Guy Carpenter, the reinsurance broker. For us, it's important to be in that market. Alternative capital originally came into the market as the cat bond market, and where it was really acting there, it was providing natural catastrophe capacity where the traditional market could not fill the entire demand of the ceding companies. At that time, of course, it was very beneficial to the market because not only provided capacity, it also introduced new business to the market. This has changed a little bit with the collateralized reinsurance, which is more competing for business, which currently is written by the traditional markets. So it puts pressure on pricing, and that has been seen particular in the catastrophe business and even more pronounced in the Florida catastrophe business, which is a very important part of the business for the ILS market. I think originally in the cat bond market, the banks were very active, and that of course was a concern to the reinsurance brokers, because they suddenly had additional competition for intermediating risk from a ceding company to reinsurance capital. But I think meanwhile, all the larger reinsurance brokers have found their space in that place as well. So for them, they can offer traditional reinsurance to their clients as well as alternative capital. So I think it's not concerning them that much at this point in time. Well, for the alternative capital, if you talk on the collateralized reinsurance, which is what we have seen in the ILS market, their business model is determined by the product that they sell, because they sell a collateralized product, which means that they need certainty sooner rather than later, because they want to get back the collateral and have it to earn new premium. That means that they need short-tail business and business with low frequency of losses, so that they know where they stand after 12 months or at least after 36 months. That precludes them from open-ended casualty business. It does not preclude them, for example, from covering fiscal year stop loss also for long-tail classes. Well, our growth is firstly driven by our relationship-driven model. We seem to be a preferred partner for many of our clients, so we have no problem in seeing new business. Not always at the price that we like, but getting the offering in, we don't seem to have a problem due to the relationship and our consistent approach to the business that dates back decades. Then, of course, in the emerging markets, the fastest growing reinsurance market is Asia Pacific, which has grown significantly, say only since 2010. So that's an area where we are very active, and which is one of the reasons for our growth and continued reason for our growth. And then also on specialty lines, such as following the financial crisis, we grew significantly on credit and surety because our peers didn't like it business at the time. And we also grow, for example, on the agricultural and on the microinsurance, particular microhealth business. There are many facets of the microinsurance market. One is, of course, coupled with microfinance, that you also offer insurance products. This is a small part of the market. The most microinsurance, if you may call it like that, is really driven by the desire of governments to bring health and agricultural insurance products to the low-income population. And here, as a reinsurer, we can offer risk management capabilities and underwriting capabilities so that we can partner with the local reinsurer and the local government agencies to form a program that is beneficial for everybody involved. I mean, last week I was traveling to India where we were discussing exactly those kind of programs. I don't think that we will become the cannabis reinsurer of the US. I mean, we haven't really got any meaningful involvement. Certainly we wouldn't do products liability on them. We would not guarantee yields or income from marijuana. Therefore, I don't think we will be bailing out the industry as Lloyd steps out. Of course, we have seen more risk-based capital, which for the reinsurance to some extent offers some opportunities to help companies with managing their capital, and we actively engaged with that, in particular in Europe. It's more like managing the capital, managing the reporting and structural requirements that come with it, because from an economic point of view, I mean, many of our clients, from a pure capital adequacy ratio, according to the new regimes, are actually very well off, actually. But it is an opportunity where we see some new business as a result of it.
For more of the S&P Insurance Conference, visit the RIN TV On Demand Library.